Hi there guys, welcome to Such Is Life, a channel dedicated to exploring the mysteries and complexities of life and philosophy revolving around it. On this channel, we will delve into a variety of topics related to life and how we live it, including personal growth, relationships, and the search for meaning and purpose. Whether you are a seasoned philosopher or just starting to think about the big questions in life, we hope you will join us on this journey of discovery and self-exploration. So sit back, relax, and let's dive into the mysteries of life together. In today's episode, we explore the banking and financial systems which are the backbone of our economy. They provide the necessary infrastructure to facilitate the flow of money and credit, enabling individuals and businesses to invest, save, and borrow. However, the recent bank runs and systemic risks that have plagued our financial system have left many wondering how to navigate this complex world of finance. The financial crisis of 2008 was a stark reminder of the systemic risks that exist in our banking and financial systems. When one bank fails, it can have a ripple effect on the entire system, causing panic and leading to bank runs. This can be devastating for individuals who have their life savings tied up in these banks, as well as for the economy as a whole. In light of this, it's essential to ask some fundamental questions about how we should navigate the world of banking and finance. Firstly, what steps can we take to protect ourselves from systemic risk? Secondly, how can we ensure that the financial system is robust and resilient to withstand shocks and crises? How can we promote financial literacy and education to empower individuals to make informed decisions about their finances? Bank runs and financial crises have a long history dating back to the early days of banking. One of the earliest recorded bank runs occurred in the Netherlands in the 17th century. At that time, Dutch banks issued paper money that was not backed by gold or silver, leading to a lack of confidence among depositors and ultimately, bank runs. Fast forward to the 21st century, and we have seen several high-profile financial crises, such as the 2008 global financial crisis. The crisis was triggered by a combination of factors, including the subprime mortgage crisis, excessive risk-taking by financial institutions, and inadequate regulation and supervision. During a bank run, depositors rushed to withdraw their money from a bank, leading to a liquidity crisis for the bank. In some cases, the bank may not have enough cash on hand to meet all the withdrawal requests, leading to its collapse. Bank runs can be triggered by a variety of factors, including rumors, news events, and lack of confidence in the banking system. To prevent bank runs, banks operate on a fractional reserve system, which means that they keep only a fraction of their deposits on hand as cash reserves. The rest of the deposits are used to make loans and other investments. This system works well as long as depositors have confidence in the bank and do not all try to withdraw their money at the same time. However, in times of crisis, the fractional reserve system can lead to a liquidity crisis and bank runs. This is where the role of central banks comes in. Central banks act as lenders of last resort, providing emergency liquidity to banks in times of crisis to prevent bank runs and systemic risk. Historically, bank runs have been associated with significant declines in stock markets. This is because bank runs often occur during times of economic uncertainty, and investors tend to become more risk-averse during such periods. As a result, investors may sell their stocks and move their investments into safer assets, such as bonds or cash. This can lead to a decline in stock prices as the demand for stocks decreases. Furthermore, bank runs can also lead to a reduction in the availability of credit, which can negatively impact businesses and the economy as a whole. Banks may become hesitant to lend money during times of uncertainty, and borrowers may become reluctant to take on additional debt. This can result in a slowdown in economic activity, leading to lower corporate earnings and lower stock prices. However, the correlation between bank runs and stock markets can be complex and may depend on various factors, such as the severity of the bank run and the overall state of the economy. For example, during the 2008 global financial crisis, the collapse of several large banks led to a significant decline in stock prices. However, the subsequent government intervention and monetary policy measures helped to stabilize the financial system and contributed to a recovery in stock prices. Inculcating a rational mind in times of financial crises requires an understanding of the history and workings of the banking system, as well as a solid understanding of risk management and diversification. By spreading investments across different asset classes, such as stocks, bonds, and commodities, investors can reduce their exposure to any single asset and minimize the risk of losses due to a single event. To navigate bank runs and have a rational and long-term view, there are several steps that investors can take. Diversify your investments. As we discussed earlier, diversification is key to reducing investment risk. By investing in a variety of asset classes, such as stocks, bonds, and commodities, investors can reduce their exposure to a single asset class and minimize the risk of losses due to a single event. Stay informed. During times of economic uncertainty, it is important to stay informed about the current state of the financial system and the economy. This includes keeping up to date with news and analysis from reputable sources, as well as monitoring economic indicators such as GDP, inflation, and unemployment. Avoid emotional decision making. During times of market volatility, it is easy to get caught up in emotional decision making. Investors may be tempted to sell their investments in a panic, but this can often lead to significant losses. Instead, it is important to maintain a long-term view and stick to your investment strategy. Have a diversified income stream. In addition to diversifying your investments, having a diversified income stream can also help to reduce risk. This includes having multiple sources of income, such as rental income, dividends, and freelance work. Consider professional advice. Finally, investors may want to consider seeking professional advice from a financial advisor during times of economic uncertainty. A financial advisor can help investors to navigate the market and develop a long-term investment strategy that is tailored to their individual needs and risk tolerance. It can also be said that during these fearful times, there may be opportunities for investors to capitalize on market volatility and potentially generate higher returns. However, it is important to note that any investment opportunity comes with its own set of risks, and investors should thoroughly research and assess any potential investment before committing funds. Here are some ways investors can potentially capitalize on market volatility. Buy undervalued stocks. During times of market volatility, stocks may be trading at a discount to their intrinsic value. This presents an opportunity for investors to purchase quality stocks at a lower price. However, investors should be careful not to invest in companies with underlying issues that may affect their long-term growth prospects. Invest in defensive sectors. During times of economic uncertainty, defensive sectors such as utilities, healthcare, and consumer staples tend to be more resilient. These sectors may offer investors a more stable source of returns during market volatility. Look for opportunities in emerging markets. Emerging markets may offer higher growth potential than developed markets, but also come with higher risk. However, during market downturns, emerging markets may be trading at a larger discount to their intrinsic value, providing an opportunity for investors to potentially generate higher returns. Consider alternative investments. Alternative investments, such as real estate, private equity, and hedge funds, may offer diversification benefits and potentially higher returns. However, these investments may come with higher fees and liquidity risk, and investors should thoroughly research and understand the risks before investing. So what can we conclude from this? Well, we know the tendency for humans to react emotionally during times of financial crisis and market volatility is a well-documented phenomenon. Fear, panic, and herd mentality can lead to irrational decision-making, such as selling stocks at a loss or avoiding investments altogether. To stay ahead of everyone else, investors should strive to understand and manage their own emotions and biases. This includes developing a rational and disciplined investment strategy and sticking to it, even during times of market volatility. Additionally, investors may be able to capitalize on the emotional tendencies of others by remaining calm and disciplined when others are panicking. By keeping a level head and staying focused on their long-term investment strategy, investors may be able to take advantage of short-term market fluctuations and capitalize on opportunities that others may be overlooking. In conclusion, financial crises and market volatility are inevitable in the world of investing. However, by understanding the history and workings of the banking system, practicing risk management and diversification, and maintaining a rational and disciplined investment strategy, investors can navigate these challenges and potentially capitalize on opportunities for growth and wealth creation. At a deeper level, the lessons we can learn from investing also offer insights into the human condition. Our emotional tendencies, biases, and reactions to uncertainty and fear are universal traits that extend beyond the world of finance. By practicing self-awareness, emotional intelligence, and rational decision-making, we can cultivate not only financial success but also personal growth and fulfillment. So there you go, folks. Thanks for joining us on Such Is Life channel for this brief thought experiment. We hope that you have enjoyed exploring the mysteries and complexities of life and philosophy with us. Remember, life is a journey of self-discovery and personal growth, and there is always more to learn and discover. We encourage you to continue thinking deeply about the big questions in life and to seek out new experiences and perspectives that can help you to grow and evolve. We look forward to sharing more insights and ideas with you on future episodes of Such Is Life. If you like the content, we would love to hear your comments below, and remember to have a healthy discussion so we all can benefit together. We would appreciate it if you could share, like and subscribe and turn on the notification bell to be updated with our upcoming thought-provoking discussions on this channel. One small gesture from you, means the world to us as we try to navigate our own YouTube life. Until next time, guys, take care and keep exploring the mysteries of life.